Question 1. Policy structure and features. What is the significance of the elimination period ECA long-term care insurance policy? A. It is the period when the policyholder can decide whether to cancel the policy without penalty. B. It is the waiting period after the policyholder qualifies for benefits but before payments begin. C. It is the time during which the insurance company must approve a claim before benefits are paid. D. It is the minimum period the policy must be in effect before benefits can be used. Answer. B. Explanation. The elimination period of ECA long-term care insurance (ECI) policy refers to the waiting period after the policyholder qualifies for benefits but before the insurance company begins paying those benefits. The policyholder is responsible for covering the costs of care during this period. It is similar to a deductible in other types of insurance. The elimination period can range from 0 to 180 days or more, and selecting a longer elimination period typically results in lower premiums. This feature is critical because it helps manage the cost of the policy. NAIC model laws and Louisiana regulations mandate clear communication regarding elimination periods to ensure consumers understand the costs involved during this phase. It is incorrect because the cancellation period without penalty is usually part of the free look period, not the elimination period. C is incorrect as the elimination period does not concern claim approval. D is incorrect because it describes a vesting period, which does not apply to LTCI. Question 2. Scenario-based. Mrs. Hernandez purchased a long-term care insurance (ECA) policy that includes a compound inflation protection feature. After 5 years, she needs home health care. How will the inflation protection affect her benefits? A. Her benefits will increase by a set dollar amount each year to cover inflation. B. Her benefits will double every 5 years, regardless of the inflation rate. C. Her benefits will increase annually by a percentage of the original benefit amount. D. Her benefits will increase annually by a percentage of the current benefit amount, compounding over time. Answer. D. Explanation. In policies with compound inflation protection, the benefits increase each year by a percentage of the current benefit amount, meaning the increase compounds over time. For example, if the policy has a 5% compound inflation protection, the benefit amount in year 2 would be 5% higher than year 1, and the increase for year 3 would be based on the higher year 2 amount. This allows the policy to keep pace with the rising costs of care, which can significantly increase over time. It is incorrect because increasing by a set dollar amount is typically a feature of simple inflation protection, not compound inflation. B is incorrect because the benefits do not double every 5 years as they grow at a specified rate. C is incorrect because the compound feature increases based on the current, not the original, benefit amount. The Louisiana Department of Insurance requires policies with inflation protection to offer compound options, ensuring policyholders have adequate coverage as costs of care rise. Question 3. Medicaid and long-term care. Which of the following is not true regarding the interaction between Medicaid and long-term care insurance? A. Medicaid may require applicants to spend down their assets to qualify for long-term care benefits. B. Long-term care insurance policies often help individuals delay or avoid the need for Medicaid by covering care costs privately. C. Once a person qualifies for Medicaid, they can keep their long-term care insurance policy without restrictions. D. Medicaid estate recovery can reclaim benefits paid after the policyholder's death from their estate. Answer. C. Explanation. C is not true. Once an individual qualifies for Medicaid, continuing to hold a long-term care insurance (ECI) policy could affect Medicaid eligibility or benefits depending on the state's regulations. In many cases, Medicaid requires full disclosure of the policy, and benefits from the LTCI may need to be used first before Medicaid steps in, or the policy may need to be assigned to the state. It is correct because Medicaid often has spend-down requirements where applicants must reduce their assets to qualify. B is correct because LTCI policies provide private funds for long-term care, reducing reliance on Medicaid. D is correct because under federal law and Louisiana's Medicaid estate recovery rules, Medicaid can reclaim benefits paid for long-term care from the recipient's estate after death, depending on certain conditions. Medicaid planning is a crucial area in understanding how LTCI and state-specific regulations, such as those in Louisiana, interact with federal Medicaid guidelines. Question 4. Types of long-term care insurance policies. Which of the following statements about hybrid long-term care insurance policies is accurate? A. Hybrid policies combine long-term care insurance with life insurance or an annuity, providing flexibility if care is not needed. B. Hybrid policies provide higher benefits but at significantly higher premiums than traditional long-term care insurance. C. Hybrid policies allow the insured to receive both long-term care benefits and full life insurance benefits simultaneously. D. Hybrid policies are designed exclusively for short-term care, providing limited coverage for long-term care services. Answer A. Explanation. Hybrid long-term care insurance policies combine long-term care coverage with other products such as life insurance or annuities. These policies are designed to offer flexibility. If the insured never needs long-term care, their beneficiaries may receive a life insurance death benefit, or the policyholder might access the cash value through an annuity. B is incorrect because while hybrid policies may offer flexibility, they do not necessarily provide higher benefits than traditional LTCI. Premiums can be comparable or even more affordable in certain cases. C is incorrect because most hybrid policies allow either the use of long-term care benefits or life insurance benefits, but not both simultaneously. D is incorrect because hybrid policies typically provide comprehensive long-term care coverage, not limited short-term care. Louisiana's LTC regulations allow for hybrid policies, and insurers must clearly explain the interaction between long-term care and life insurance annuity benefits. Question 5. Claims process and payment of benefits. When filing a claim for long-term care insurance benefits, what documentation is typically required to initiate the claim? A. The policyholder's original policy document and proof of financial hardship. B. A physician's certification of the policyholder's need for long-term care and a written plan of care. C. Evidence of a cognitive impairment test only. D. Proof of hospitalization within the last 30 days before long-term care services are needed. Answer B. Explanation. To initiate a claim for long-term care insurance (LTCI) benefits, most policies require a physician's certification confirming that the policyholder requires long-term care services due to their inability to perform activities of daily living adults or due to cognitive impairment. In addition, a written plan of care prepared by a licensed health professional is generally necessary to outline the services the policyholder will receive. Is incorrect because neither the original policy document nor proof of financial hardship is required to file a claim. C is incorrect as cognitive impairment tests are only one part of the claim process if cognitive issues like dementia are involved. D is incorrect because hospitalization is not typically required to trigger long-term care benefits. The trigger is usually based on a DLS or cognitive impairment. Louisiana law aligns with federal requirements, which specify that the benefit triggers for long-term care insurance claims must be clearly defined in the policy, and a physician's certification is a common requirement. Question 6. Ethical and legal considerations. Which of the following practices would be considered an unethical sales practice under Louisiana long-term care insurance regulations? A. Offering discounts to family members if multiple policies are purchased. B. Recommending a policy with benefits far in excess of what the client is likely to need or afford. C. Providing a thorough explanation of all policy features, including exclusions. D. Suggesting a lower-cost policy option that meets the client's current financial situation. Answer B. Explanation. Recommending a policy with benefits far in excess of what the client needs or can afford is considered an unethical sales practice because it may cause the client to purchase unnecessary coverage or result in future financial strain. This practice violates suitability standards, which require that policies be appropriate for the client's financial situation, health needs, and long-term care planning objectives. It is incorrect because offering discounts for family members may be allowed as long as it is part of the insurer's approved marketing program. C is incorrect because providing thorough explanations is an ethical obligation for agents. D is incorrect because recommending a policy that fits the client's financial situation is an ethical practice. Louisiana regulations, in alignment with the NAIC Model Act, emphasize the ethical responsibility of agents to ensure that policies are suitable for the consumer's needs. Question 7. Underwriting for long-term care insurance. Which factor is least likely to impact an individual's eligibility for long-term care insurance during the underwriting process? A. The individual's age at the time of application. B. The individual's occupation at the time of application. C. The individual's medical history, including pre-existing conditions. D. Results from cognitive tests or memory assessments. Answer B. Explanation. An individual's occupation is the factor least likely to impact eligibility for long-term care insurance. Unlike other types of insurance, e.g., disability insurance, long-term care insurance underwriting primarily focuses on age, health status, and cognitive abilities to assess future risk. The insurer evaluates these factors to determine eligibility and premium rates. It is incorrect because age significantly impacts premiums and eligibility. The older the applicant, the higher the risk and the cost. C is incorrect because medical history, particularly pre-existing conditions, plays a critical role in underwriting. D is incorrect because cognitive testing is a key part of the underwriting process, especially given the increasing risk of conditions like Alzheimer's as individuals age. Louisiana law mandates clear disclosure of underwriting requirements to ensure consumers understand the factors influencing their eligibility. Question 8. Medicaid and long-term care. What is one key benefit of purchasing a Louisiana long-term care partnership program policy? A. The policyholder's assets are completely exempt from Medicaid's spend-down requirements. B. The policyholder's assets are protected from Medicaid estate recovery up to the amount paid out in benefits by the policy. C. The policyholder is guaranteed full Medicaid eligibility without regard to income or assets. D. The policyholder receives tax-free benefits without needing to report them to the IRS. Answer: B. Explanation. A key benefit of purchasing a Louisiana long-term care partnership program policy is that it allows the policyholder to protect an amount of assets from Medicaid estate recovery equal to the amount of long-term care insurance benefits payout. This feature encourages individuals to purchase private long-term care insurance by providing asset protection while still qualifying for Medicaid if necessary. It is incorrect because assets are not completely exempt from Medicaid's spend-down requirements, but the policy offers partial protection. C is incorrect because the policyholder must still meet income and other eligibility requirements for Medicaid, even with a partnership policy. D is incorrect because tax-free benefits from LTCI are determined by RS guidelines, not by the partnership program itself. The Louisiana Long-Term Care Partnership Program, part of the Deficit Reduction Act and NAIC model laws, incentivizes long-term care insurance purchases by offering this asset protection. Question 9. Coverage and exclusions in long-term care insurance. Which of the following services is typically not covered under a traditional long-term care insurance policy? A. Hospice care for individuals with terminal illnesses. B. Respite care for temporary relief of a primary caregiver. C. Custodial care in a skilled nursing facility. D. Treatment for mental or nervous disorders, including anxiety or depression. Answer: D. Explanation. Mental or nervous disorders, including anxiety and depression, are typically excluded from coverage under traditional long-term care insurance policies. LTCI policies focus on covering services related to physical impairments and cognitive impairments like Alzheimer's disease or dementia, but often exclude psychiatric or emotional conditions. It is incorrect because hospice care is generally covered, particularly for those with terminal illnesses. B is incorrect because respite care, which provides temporary relief for primary caregivers, is usually covered. C is incorrect because custodial care, including help with activities of daily living, is a fundamental part of LTCI coverage in skilled nursing facilities. Louisiana's LTC regulations require insurers to clearly define exclusion clauses, ensuring consumers understand the limits of coverage. Question 10. Tax benefits of long-term care insurance. Which of the following tax advantages does Louisiana provide for policyholders of qualified long-term care insurance? A. Premiums are fully deductible regardless of the policyholder's age or income. B. Benefits received from a qualified long-term care policy are generally tax-free. C. Policyholders receive a dollar-for-dollar tax credit equal to the amount of premiums paid. D. Policyholders can exclude long-term care insurance premiums from their gross income when calculating state income taxes. Answer: B. Explanation. For qualified long-term care insurance policies, benefits received to pay for long-term care services are generally tax-free as long as they do not exceed the actual costs of care. This is a significant tax advantage for policyholders. However, the premiums are only partially deductible and based on the policyholder's age and medical expenses in a given year rather than fully deductible. Is incorrect because premiums are not fully deductible and the amount of deduction is subject to limits and age-based caps. C is incorrect because there is no direct tax credit for long-term care insurance premiums. D is incorrect as long-term care insurance premiums are not excluded from gross income for state taxes in Louisiana. Louisiana follows federal rules, and IRS Section 7712 governs the tax treatment of long-term care insurance. Question 11. Non-forfeiture benefits. What is the purpose of a non-forfeiture benefit in a long-term care insurance policy? A. To guarantee the policyholder a return of all premiums paid if they cancel their policy. B. To provide reduced paid-up benefits if the policy lapses due to non-payment of premiums. C. To allow the policyholder to withdraw funds from their policy for other health-related expenses. D. To increase the policy's benefit amounts over time without raising premiums. Answer: B. Explanation. A non-forfeiture benefit ensures that the policyholder receives reduced paid-up benefits if the policy lapses due to non-payment. This means the policyholder will still have some coverage, though at a reduced level, rather than losing all coverage. This is a key feature for individuals who may face financial difficulties later in life and struggle to continue premium payments. It is incorrect because the non-forfeiture benefit does not guarantee the return of all premiums, it only provides continued, though reduced, coverage. C is incorrect as long-term care policies do not typically allow for the withdrawal of funds. D is incorrect because non-forfeiture benefits do not increase the benefit amounts or change the premiums. Louisiana law requires insurers to offer non-forfeiture benefits or comparable options in long-term care insurance policies. Question 12. Elimination periods in long-term care policies. What is the elimination period in a long-term care insurance policy? A. The time between the policy's purchase and the first premium payment. B. The period during which no benefits are paid even though the insured qualifies for long-term care services. C. The length of time after a claim is submitted until the insurance company begins paying benefits. D. The period when the policyholder is required to pay coinsurance before the policy covers the remaining expenses. Answer: B. Explanation. The elimination period in a long-term care insurance policy refers to a waiting period, often 30, 60, or 90 days after the policyholder becomes eligible for benefits, during which no benefits are paid. During this time, the insured is responsible for covering their own care costs. A is incorrect because the elimination period does not relate to premium payments. C is incorrect as the elimination period refers to the time before benefits start, not the time after submitting a claim. D is incorrect because coinsurance is not typically associated with long-term care policies. Louisiana policies often offer flexibility in choosing elimination periods, which can influence the premium cost. The longer the elimination period, the lower the premium. Question 13. Inflation protection options. What is the main advantage of selecting inflation protection with a long-term care insurance policy? A. It allows the policyholder to increase their benefit amounts after retirement without additional premiums. B. It ensures that the policy's benefits keep pace with the rising costs of long-term care services. C. It provides a tax deduction for any premium increases due to inflation. D. It allows the policyholder to receive benefits in cash instead of reimbursed expenses. Answer: B. Explanation. Inflation protection ensures that a policy's benefits increase over time to keep pace with the rising costs of long-term care services, which tend to increase significantly due to healthcare inflation. Without this protection, the benefits might become insufficient to cover care costs in the future. O is incorrect because premiums usually increase when inflation protection is added. C is incorrect because inflation protection does not offer a tax deduction on premiums. D is incorrect because inflation protection has no effect on the form of benefits, cash versus reimbursement. Louisiana requires insurers to offer inflation protection, and consumers are encouraged to consider it, especially for younger buyers of long-term care insurance. Question 14. Qualifying for benefits. Which of the following conditions would typically qualify an individual to receive long-term care insurance benefits? A. A mild case of the flu requiring bed rest. B. Inability to perform 2 or more activities of daily living, adults, such as bathing and dressing. C. Chronic back pain that does not limit mobility or cognitive function. D. Short-term hospitalization following surgery. Answer: B. Explanation. An individual typically qualifies for long-term care insurance benefits when they are unable to perform 2 or more activities of daily living, adults. A DLS include basic self-care tasks such as bathing, dressing, eating, toileting, transferring, and continence. A is incorrect because a mild illness does not typically meet the threshold for long-term care benefits. C is incorrect because chronic back pain alone does not usually qualify unless it significantly impairs the ability to perform, adults. D is incorrect as short-term hospitalization is generally covered by health insurance, not long-term care insurance. Louisiana's LTC regulations align with federal rules on adult-based benefit triggers for long-term care insurance claims. Question 15. Comprehensive versus facility-only policies. What is the difference between a comprehensive long-term care policy and a facility-only policy? A comprehensive policy covers both institutional care and home care, while a facility-only policy covers care in specific facilities like nursing homes. B. A comprehensive policy provides benefits for any type of care, including health insurance, while a facility-only policy covers only Medicare services. C. A comprehensive policy allows for higher benefit limits, while a facility-only policy has capped benefits. D. A comprehensive policy requires higher premiums but covers any condition, while a facility-only policy excludes pre-existing conditions. Answer A. Explanation. A comprehensive long-term care insurance policy covers a wide range of care settings, including both institutional care and home care. In contrast, a facility-only policy provides coverage solely for care in specific institutions such as nursing homes or assisted living facilities. B is incorrect because neither policy type covers health insurance or Medicare services. C is incorrect because the benefit limits are not inherently higher in comprehensive policies, although the scope of coverage is broader. D is incorrect as both types of policies may have pre-existing condition clauses, but this is not a defining difference. Louisiana mandates clear disclosures about the type of policy to help consumers choose between comprehensive and facility-only options. Question 16. Policy renewability. What does it mean if a long-term care insurance policy is guaranteed renewable? A. The insurer can cancel the policy only if premiums are not paid. B. The insurer can increase the premiums at any time for any reason. C. The policyholder can reduce their premiums by lowering the coverage amount. D. The insurer can cancel the policy at the end of each term but must offer renewal. Answer A. Explanation. A guaranteed renewable policy means that the insurer cannot cancel the policy as long as the policyholder continues to pay the premiums. However, the insurer can increase premiums for an entire class of policyholders, not just for one individual. B is incorrect because while premiums can increase, they must apply to all policyholders in a specific class. C is incorrect because reducing premiums by lowering coverage is not related to the renewability of the policy. D is incorrect because guaranteed renewable policies cannot be cancelled by the insurer at the end of each term. Louisiana law requires that long-term care policies be either guaranteed renewable or non-cancelable, providing policyholders with security that their coverage will continue. Question 17. Pre-existing condition clauses. How do pre-existing condition clauses in long-term care insurance policies affect coverage? A. Pre-existing conditions are always excluded from coverage. B. Pre-existing conditions are excluded for a specified waiting period after the policy is issued. C. Pre-existing conditions are covered immediately if they were disclosed during the application. D. Pre-existing conditions are covered only after a 3-year waiting period. Answer B. Explanation. Most long-term care insurance policies have pre-existing condition clauses which exclude coverage for conditions that existed before the policy's effective date for a specified waiting period, often 6 months or more, depending on the policy. After this waiting period, coverage may begin for conditions that were pre-existing. This ensures that insurers can manage risk while still providing coverage after an initial period. It is incorrect because pre-existing conditions are not always excluded indefinitely. C is incorrect because disclosure during the application process does not typically result in immediate coverage for pre-existing conditions. D is incorrect because the waiting period for pre-existing conditions is usually much shorter than 3 years. Louisiana regulations allow insurers to impose a pre-existing condition exclusion period but require it to be clearly disclosed in the policy. Question 18. Partnership Program for Long-Term Care. How does Louisiana's long-term care partnership program benefit policyholders? A. It provides discounted premiums for policyholders who purchase long-term care insurance before age 50. B. It allows policyholders to protect assets from Medicaid spend-down requirements equal to the amount of benefits paid by the insurance policy. C. It guarantees full coverage of all long-term care costs, regardless of the policyholder's assets. D. It offers a federal tax credit for purchasing a long-term care insurance policy. Answer B. Explanation. Louisiana's long-term care partnership program allows policyholders to protect assets from being counted towards Medicaid spend-down requirements up to the amount of benefits paid by their long-term care insurance policy. This encourages the purchase of private long-term care insurance while still providing a safety net if Medicaid is needed. Is incorrect because the program does not offer discounted premiums based on age. C is incorrect because the program does not guarantee full coverage of all long-term care costs. D is incorrect because the program does not offer a federal tax credit for purchasing long-term care insurance. The partnership program is designed to incentivize planning for long-term care needs while reducing the financial burden on Medicaid. Question 19. Benefit triggers in long-term care insurance. Which of the following is the most common trigger for receiving long-term care benefits in Louisiana? A. A physician's recommendation for long-term care services. B. The policyholder's inability to perform two or more activities of daily living adults. C. The policyholder's age of 65 or older. D. A diagnosis of a chronic illness regardless of the policyholder's ability to perform adults. Answer. B. Explanation. The most common benefit trigger in long-term care insurance policies is the inability to perform two or more activities of daily living adults. This typically includes tasks such as bathing, dressing, eating, toileting, and transferring. Is incorrect because a physician's recommendation alone is not typically enough to trigger benefits. C is incorrect because age is not a trigger for benefits. D is incorrect because the policyholder must meet specific criteria related to adults, not just have a diagnosis. Louisiana policies follow federal standards which use a DL criteria as a benefit trigger. Question 20. Home care versus institutional care coverage. How does home care coverage differ from institutional care coverage in long-term care policies? A. Home care coverage is generally more expensive than institutional care coverage. B. Home care coverage typically includes assistance with adults, while institutional care only covers medical treatments. C. Institutional care coverage usually provides broader benefits, including room and board, whereas home care coverage may have limits on the type and duration of care. D. Home care coverage is automatically included in all long-term care policies, but institutional care must be purchased as a rider. Answer. C. Explanation. Institutional care coverage in long-term care policies generally provides broader benefits, including room and board in a facility, along with medical and personal care. Home care coverage often has limitations on the types of services provided and the duration of care, such as only covering part-time assistance with adults. Is incorrect because home care coverage is not typically more expensive than institutional care, though it can vary. B is incorrect because institutional care covers both medical treatments and assistance with adults. D is incorrect because home care coverage is not automatically included in all policies and may be an optional rider. Louisiana policies may vary in the extent of home care coverage, and consumers should carefully evaluate what is covered. Question 21. Lapse and reinstatement provisions. Which of the following best describes the lapse and reinstatement provisions in long-term care insurance policies? A. The policy will automatically reinstate after a lapse if the policyholder pays the overdue premium within 60 days. B. The policy cannot be reinstated after a lapse, and a new policy must be purchased. C. The policy may be reinstated if the lapse was due to cognitive impairment and the request is made within 5 months of the lapse. D. The policy can be reinstated without paying overdue premiums if the policyholder provides a medical certification of need. Answer. C. Explanation. Most long-term care policies include a reinstatement provision that allows the policy to be reinstated if the lapse occurred due to cognitive impairment or loss of functioning, as long as the request is made within a specific period, often up to 5 months after the lapse. Is incorrect because reinstatement is not automatic and payment within 60 days does not guarantee reinstatement. B is incorrect because policies often have a reinstatement provision under certain conditions. D is incorrect because the overdue premiums typically must be paid for reinstatement. Louisiana mandates that long-term care policies include provisions for reinstatement if the lapse was unintentional due to a cognitive condition. Question 22. Shared care rider. What is a shared care rider in a long-term care insurance policy? A. A provision that allows two policyholders to share a pool of long-term care benefits. B. A rider that covers long-term care services provided by family members. C. A provision that allows unused benefits to be transferred to a family member after the policyholder's death. D. A rider that guarantees the policyholder can receive care in a shared living facility at a reduced cost. Answer A. Explanation. A shared care rider allows two policyholders, typically spouses, to share a pool of long-term care benefits. If one policyholder uses up their benefits, they can access the other's remaining benefits. This is a popular option for couples who want flexibility in how their benefits are used. B is incorrect because a shared care rider does not cover care provided by family members. C is incorrect because unused benefits are not typically transferred after death. D is incorrect because the rider does not specifically relate to shared living facilities. In Louisiana, insurers may offer shared care riders as an option to enhance policy flexibility for couples. Question 23. Waiver of premium. What does the waiver of premium provision in a long-term care policy do? A. It eliminates the requirement to pay premiums once the policyholder begins receiving benefits. B. It refunds all premiums paid if the policyholder passes away before benefits are used. C. It allows the policyholder to pause premium payments during periods of financial hardship. D. It reduces the policyholder's premiums based on their income level. Answer A. Explanation. The waiver of premium provision in long-term care insurance eliminates the requirement to pay premiums once the policyholder starts receiving benefits. This prevents financial strain on individuals who are already paying for care services. B is incorrect because it does not refund premiums after death. C is incorrect because the waiver of premium provision does not relate to financial hardship. D is incorrect as the provision is not income-based. Louisiana regulations require insurers to offer the waiver of premium provision in long-term care policies. Question 24. Inflation protection in long-term care policies. Why is purchasing inflation protection important in a long-term care insurance policy? A. It guarantees that premiums will not increase over time. B. It ensures that benefits keep pace with the rising costs of long-term care services. C. It provides a tax deduction for the policyholder. D. It automatically extends coverage to family members without additional premiums. Answer. B. Explanation. Inflation protection is crucial in long-term care insurance because it ensures that the policy's benefits increase over time to keep pace with the rising costs of care. Without inflation protection, the fixed benefit amount may become insufficient as the cost of long-term care services increases due to inflation. A is incorrect because inflation protection does not prevent premium increases. C is incorrect because inflation protection does not provide a tax deduction. D is incorrect because inflation protection does not extend coverage to family members. In Louisiana, inflation protection is often offered as an optional rider and is strongly recommended for long-term care policies. Question 25. Non-forfeiture benefit in long-term care insurance. What is the purpose of a non-forfeiture benefit in a long-term care insurance policy? A. It allows the policyholder to recover premiums paid if they never use long-term care services. B. It guarantees a reduced level of coverage if the policy lapses after a certain period. C. It ensures that premiums will not increase after the policyholder reaches a specific age. D. It provides extended benefits to the policyholder's dependents. Answer. B. Explanation. The non-forfeiture benefit guarantees that if a policyholder stops paying premiums and the policy lapses, they will still receive a reduced level of coverage. This helps policyholders who may no longer be able to afford premiums maintain some level of protection. It is incorrect because the benefit is not a premium refund feature. C is incorrect because non-forfeiture does not affect premium increases. D is incorrect because the non-forfeiture benefit does not extend to dependents. Louisiana regulations require insurers to offer non-forfeiture benefits as an option in long-term care policies. Question 26. Elimination period in long-term care insurance. What does the elimination period in a long-term care insurance policy refer to? A. The period during which no benefits are paid but premiums are waived. B. The period before the policy becomes effective. C. The waiting period after qualifying for benefits during which the policyholder must pay out of pocket for care. D. The time frame during which the policyholder can cancel the policy without penalty. Answer. C. Explanation. The elimination period is the waiting period after a policyholder becomes eligible for benefits but must pay out of pocket for care. After this period, the insurance benefits begin. Common elimination periods range from 30 to 90 days. It is incorrect because premiums may or may not be waived during the elimination period. B is incorrect because the elimination period refers to a waiting period for benefits, not the policy's start date. D is incorrect because the elimination period is not related to policy cancellation. In Louisiana, elimination periods help insurers manage costs and policyholders balance premiums and out-of-pocket expenses. Question 27. Qualified long-term care insurance. What is a qualified long-term care insurance policy under federal law? A policy that qualifies the policyholder for federal subsidies to assist with premium payments. B. A policy that provides tax-free benefits and allows premium deductions under certain conditions. C. A policy that automatically qualifies the policyholder for Medicaid after a certain period of coverage. D. A policy that offers extended benefits for home care without additional riders. Answer B. Explanation. A qualified long-term care insurance policy under federal law provides tax-free benefits and may allow policyholders to deduct premiums on their tax returns if they meet specific criteria. The policy must meet federal guidelines regarding benefit triggers and inflation protection to qualify. Is incorrect because there are no federal subsidies specifically for long-term care insurance premiums. C is incorrect because purchasing a qualified policy does not automatically qualify someone for Medicaid. D is incorrect because qualified policies do not necessarily include extended home care benefits without riders. Louisiana offers state tax incentives for purchasing qualified long-term care insurance policies. Question 20. Guaranteed renewable policies. What does it mean if a long-term care insurance policy is guaranteed renewable? A. The policy cannot be cancelled as long as premiums are paid on time. B. The policy premiums will never increase over the policyholder's lifetime. C. The policy automatically renews every year without the need for premium payments. D. The policyholder can renew the policy at a discounted premium after the initial term. Answer A. Explanation. A guaranteed renewable policy means the insurer cannot cancel the policy as long as the policyholder continues to pay premiums on time. However, premiums can still be increased, but only for an entire class of policyholders, not individuals. B is incorrect because guaranteed renewable policies may still experience premium increases. C is incorrect because premiums must still be paid. D is incorrect because there is no discount involved in renewal. Louisiana law requires long-term care insurance policies to be guaranteed renewable, ensuring policyholders maintain coverage if they keep up with their payments. Question 29. Spousal discounts in long-term care insurance. How do spousal discounts typically work in long-term care insurance policies? A. Both spouses must purchase identical coverage to qualify for a discount. B. Spouses automatically receive a discount if they apply for coverage at the same time. C. Spouses can share one policy, reducing premiums for both individuals. D. One spouse receives a premium discount when both are covered, even if the coverage levels differ. Answer D. Explanation. Spousal discounts typically reduce premiums for one or both spouses when both are covered, even if the coverage levels differ. This is an incentive for couples to purchase long-term care insurance together. It is incorrect because identical coverage is not a requirement for a spousal discount. B is incorrect because spouses do not automatically receive a discount just for applying at the same time. C is incorrect because long-term care policies are individualized even with shared care riders. In Louisiana, spousal discounts vary by insurer but generally make it more affordable for couples to purchase coverage together. Question 30. Taxation of long-term care insurance benefits. How are benefits from a qualified long-term care insurance policy taxed? A. They are always taxed as ordinary income. B. They are tax-free up to a specified daily limit, with amounts above the limit taxed as income. C. They are tax-free only if the policyholder is over the age of 65. D. They are tax-free only if the policyholder itemizes deductions on their tax return. Answer B. Explanation. Benefits from a qualified long-term care insurance policy are generally tax-free up to a specified daily limit set by the IRS. Amounts received above this limit may be subject to income tax if not used for qualified long-term care expenses. It is incorrect because qualified long-term care benefits are not taxed as ordinary income. C is incorrect because tax treatment does not depend on the policyholder's age. D is incorrect because tax-free treatment does not depend on whether the policyholder itemizes deductions. Louisiana follows federal guidelines for the taxation of long-term care insurance benefits, providing policyholders with tax advantages for qualifying policies.